RSP and VOO track the same S&P 500 constituents, but they don't represent the market in the same way. One allows capital to concentrate automatically, and the other forces it to reset. That single structural difference determines where risk accumulates, how returns are generated, and which market regimes each fund is built to survive. Market cap weighting VOO. In a market cap weighted index, each company's weight is proportional to its total market value. Larger companies receive larger allocations. Weights adjust continuously as prices change. If a company outperforms the index, its weight increases automatically. No rebalance is required. Price movement alone determines allocation. Momentum and scale compound by design. Equal weighting, RSP. In an equal weighted index, each company begins with the same allocation. Weights are reset on a fixed schedule, and company size doesn't determine target exposure over time. Between rebalances, weights drift. If a company outperforms, its weight rises temporarily, and that excess weight is reduced at rebalance. If a company underperforms, its weight falls temporarily, and that shortfall is restored towards equal weight at rebalance. The process is mechanical, not discretionary. Equal weighting is not just a different allocation, it embeds a forced rebalancing rule. This rule operates continuously over time through scheduled resets. That rule does three things simultaneously. It reduces concentration risk. By resetting weights, no single company or group of companies is allowed to dominate the portfolio indefinitely. It transfers exposure from outperformers to underperformers. Positions that grow faster than the index are trimmed, and positions that lag are increased. And it converts relative dispersion into return potential. Differences in relative performance create trading activity at each rebalance. The mechanism is designed to benefit from dispersion. Outcomes depend on regime. Market cap weighting does none of these. It doesn't rebalance based on relative price movement, it doesn't trim winners, and it doesn't reinforce underperformers. Market cap weighting accepts concentration risk in exchange for efficiency. It maximizes exposure to the largest contributors to index returns, and it allows individual companies to grow into dominant portfolio positions. As concentration increases, fewer companies drive a larger share of total returns. Drawdowns are increasingly tied to reversals in dominant names. Equal weighting. It actively reduces concentration risk, caps the influence of any single company or sector, and it maintains consistent exposure across all constituents. As leaders outperform, their weights are trimmed at rebalance, exposure is redistributed to smaller and lagging names, and portfolio outcomes depend more on aggregate participation. This isn't a question of diversification versus return. It's a structural choice. It's a decision between letting winners run or continuously resetting exposure. Market cap weighted exposure tends to perform better when returns are driven by a narrow set of dominant companies. This typically occurs when a small number of firms account for a larger share of index gains. Capital remains concentrated in the same leaders. These environments are most often observed during late cycle expansions and when competitive advantages compound faster than dispersion increases. Equal weighted exposure tends to perform better when returns are broadly distributed across the index. This typically occurs when market leadership is broad-based rather than concentrated, relative performance varies meaningfully across companies, and mean reversion plays a larger role than momentum. These environments are most often observed in early stages of economic recoveries and during periods of valuation normalization. The difference is structural, not predictive. Equal weighting benefits from dispersion. Market cap weighting benefits from concentration. Outcomes depend on regime, not selection or timing. Sector exposure is not actively selected by index funds. It emerges from how capital is allocated within the index. In a market cap weighted index, sector weights expand as constituent companies grow. Sectors with rising valuations and market share receive increasing capital. As sector leaders outperform, individual company weights increase. Sector representation grows automatically. There's no internal mechanism to limit sector size. Sector dominance persists as long as relative performance continues. In an equal weighted index, each company contributes the same weight at rebalance. Sector exposure is constrained by uniform position sizing. As dominant sectors outperform, positions are trimmed at rebalance. Capital is reallocated towards smaller or lagging sectors. Equal weighted portfolios benefit when sector leadership rotates. Market cap weighted portfolios benefit when sector leadership persists. Risk characteristics differ because capital is distributed differently. In a market cap weighted portfolio, Volatility is often lower when large, liquid leaders remain resilient during stress periods. Capital is concentrated in larger, more liquid companies, and performance depends more heavily on a limited number of large positions. Because capital remains concentrated, scale and liquidity can dampen index level volatility, and fewer companies drive the majority of portfolio movement. In an equal weighted portfolio, short-term volatility is higher, exposure to mid-sized and smaller S&P 500 constituents is greater, and sensitivity to changes in market breadth is elevated. Because capital is periodically redistributed away from dominant names, returns depend more on broad participation across constituents, and individual stock volatility contributes more directly to index level movement. Risk is distributed more evenly across holdings rather than concentrated. These differences come from structure, not selection. Risk is not removed or added, it's allocated differently. Market cap weighted strategies have minimal turnover, are structurally tax efficient, and allow unrealized gains to compound. Because trading is driven mainly by index changes rather than price movement, transaction costs remain low, and tax drag is reduced over long holding periods. Equal weighted strategies require regular rebalancing, generate higher portfolio turnover, and incur high internal trading costs. These effects are structural. This cost and tax gap widens with time. RSP and VOO are not interchangeable. They express different structural assumptions within the same market. VOO is typically used as a core US equity allocation, a long duration compounding vehicle, and a lower turnover foundation for equity exposure. Its structure is designed to allow capital to remain concentrated in dominant companies and minimize friction over extended holding periods. RSP is typically used as a diversification overlay within US equities, a regime sensitive allocation, and a complement to cap weighted exposure, not a replacement. Its structure is designed to reduce concentration within the index and increase sensitivity to changes in market breadth. The choice is not about owning different assets, it's about how exposure is expressed within the same market. Relative performance between RSP and VOO alternates over time. Performance charts compress long, regime-dependent dynamics into a single line. Relative outcomes are driven by changes in market concentration, shifts in leadership breadth, and differences in return dispersion across stocks. When returns are driven by a small number of companies, market cap weighted structures benefit. When returns are distributed more evenly, equal weighted structures benefit. Choosing based on charts selects outcomes instead of mechanisms. Performance is the result, not the decision variable. The decision comes down to a single structural question. Will future returns be more influenced by a narrow group of dominant companies or by a broad participation across the market? It doesn't require forecasting individual stocks, sectors, or timing inflection points. When dominance persists, market cap weighting is structurally advantaged. Capital remains concentrated in the largest contributors. Allowing winners to compound drives a disproportionate share of returns. In this environment, reducing concentration works against the return mechanism. When leadership rotates, equal weighting is structurally advantaged. Returns are generated through redistribution rather than persistence. Portfolio outcomes depend on broad participation across constituents. In this environment, allowing concentration to persist limits participation. This isn't a short-term timing decision, it's an exposure decision. It defines how capital is allowed to respond as uncertainty unfolds over time. RSP and VOO are not competing products. Market cap weighting assumes leadership persistence and capital efficiency through concentration. Equal weighting assumes dispersion across constituents and return generation through systematic rebalancing. Neither structure is inherently superior. Each performs as expected when market conditions align with its underlying assumptions.